Hello, and welcome to Financial Market Insights for Traders. I'm Sophia, and today we're going to explore a topic that has become increasingly important for anyone trading or investing in cryptocurrency: how crypto behaves across macroeconomic cycles. When people first enter the crypto market, it's tempting to think of Bitcoin, Ethereum, and other digital assets as a completely separate financial universe. Crypto has its own technology, its own communities, its own market structure, and its own catalysts. But the crypto market doesn't operate in isolation. Interest rates matter, inflation matters, liquidity matters, bond yields matter, the US dollar matters, economic growth matters, and perhaps most importantly, investor risk appetite matters. So today we're going to take a closer look at crypto and AMP, macro correlation, or what we might also call crypto macro correlation, and examine how this relationship changes depending on the economic environment. We'll also spend quite a bit of time on risk on versus risk off dynamics, because understanding whether investors are willing to take risk or are actively trying to reduce it can provide valuable context when interpreting major moves in crypto. Let's get started. First, what exactly do we mean when we talk about crypto and AMP, macro correlation? In simple terms, we're talking about the relationship between cryptocurrency markets and the broader macroeconomic environment. That environment includes things like central bank interest rates, inflation, employment, economic growth, bond yields, currency movements, financial liquidity, and overall investor sentiment. Bitcoin is often discussed as a potential alternative monetary asset or a long-term store of value. But in the short and medium term, Bitcoin can also behave like a high-risk financial asset. That distinction is extremely important. During periods when investors are confident, liquidity is plentiful, and financial conditions are supportive, capital can move toward assets that offer higher potential returns. That can include technology stocks, emerging markets, commodities, and cryptocurrencies. This is what we generally describe as a risk-on environment. In contrast, when investors become worried about inflation, recession, financial instability, geopolitical events, or rapidly rising interest rates, they often become more defensive. That's a risk-off environment, and crypto can respond dramatically to that change in investor psychology. Let's look at the risk-on side first. Imagine an economy where growth expectations are improving, inflation is becoming manageable, interest rates are stable or expected to decline, and financial market liquidity is relatively healthy. Investors may become more comfortable taking risk. Money can flow into equities and other growth assets. Volatility may remain contained, credit conditions may improve, and speculative assets can attract additional capital. Crypto can benefit from this environment. Bitcoin may attract institutional interest. Ethereum and other major digital assets may see stronger demand, and capital can rotate further down the crypto risk curve into smaller and more speculative tokens. This is one reason why crypto performance during risk-on markets can be so strong. But there's an important warning here. Risk-on doesn't automatically mean that every cryptocurrency will rise. Crypto-specific fundamentals still matter. Regulation matters. Network activity matters. Institutional flows matter. Market positioning matters. Leverage matters. Macro conditions are the backdrop. They aren't the entire story. Now, let's move to the other side of the equation. What happens during a risk-off environment? Suppose inflation is unexpectedly persistent. Central banks respond by raising interest rates aggressively. Bond yields move higher. Economic growth expectations weaken, and investors become concerned about a recession. Suddenly, the investment environment changes. Investors may start reducing exposure to higher risk assets. They may sell equities, reduce leverage, increase cash holdings, or move toward assets they perceive as safer. Crypto can be particularly vulnerable because it is highly volatile and because leverage plays a major role in digital asset markets. A falling Bitcoin price can trigger liquidations. Those liquidations create additional selling pressure. More selling can trigger further liquidations. That's how a relatively modest decline can sometimes develop into a much larger crypto market drawdown. This is a crucial part of risk-on versus risk-off dynamics in cryptocurrency markets. Now let's talk about interest rates. Interest rates are one of the most important macro variables for financial markets generally. and they can have a significant influence on cryptocurrency valuations. When interest rates rise, the cost of borrowing increases. At the same time, investors can receive more attractive returns from relatively lower risk assets, such as government bonds and cash like instruments. That can reduce the appeal of speculative investments. Higher interest rates can also contribute to tighter financial conditions, reducing the amount of liquidity available to chase risk assets. When rates decline, the opposite can happen. Borrowing becomes cheaper. Financial conditions may become more supportive. Investors may become more willing to search for higher returns. That can create a more favorable environment for crypto. However, there's another important point. Markets trade expectations. Crypto doesn't necessarily wait for a central bank to actually cut or raise rates. If traders strongly expect future rate cuts, financial markets can begin pricing that possibility months in advance. That's why anyone studying interest rates and Bitcoin prices should pay attention not only to the current policy rate, but also to inflation expectations, employment data, bond yields, central bank communications, and market expectations for future policy. Now let's move to inflation. Inflation is particularly interesting when discussing Bitcoin. Some investors view Bitcoin's limited supply as a potential hedge against monetary debasement. But in the short term, the relationship between inflation and Bitcoin isn't that straightforward. Why? Because the market response to inflation matters. Imagine inflation rises sharply. If investors believe the central bank will respond with aggressive monetary tightening, bond yields could rise and liquidity could fall. That can be negative for crypto. So, when asking how inflation affects cryptocurrency prices, we need to consider not just the inflation number, but also what that number means for monetary policy. This brings us to one of the most important concepts in modern markets: liquidity. Liquidity essentially describes how easily capital is available throughout the financial system. When global liquidity expands, financial assets can benefit because there is more capital available for investment and speculation. When liquidity contracts, investors can become more selective. This is why understanding global liquidity and Bitcoin performance can be so useful. A trader who watches only the Bitcoin chart may miss an important part of the story. The Bitcoin chart tells us what happened to price. Macro indicators can sometimes help us understand why the broader investment environment may be changing. Another important variable is the US dollar. Because Bitcoin and many other global financial assets are priced in US dollars, significant changes in dollar strength can influence crypto markets. A stronger dollar can coincide with tighter global financial conditions, particularly for borrowers and investors exposed to dollar funding. A weaker dollar can sometimes accompany easier financial conditions and stronger demand for risk assets. Again, this isn't an absolute rule. Markets are complex and correlations can change. That's one of the most important lessons when studying crypto macro correlation. Correlation isn't a permanent law. It changes. At certain points, Bitcoin can trade very closely with technology stocks. At other times, crypto-specific developments can dominate. Sometimes macroeconomic news drives the market. At other times, an important regulatory announcement, institutional development, network upgrade, or major change in crypto market structure can overwhelm the macro signal. This means traders should be careful about saying, Bitcoin always moves with equities, or Bitcoin always benefits from lower rates. Those statements are too simplistic. A better question is, what is driving the market right now? Let's consider the broader economic cycle. We can think about 4 general stages. The first is expansion. Economic growth is improving, confidence is strengthening, and investors generally become more comfortable with risk. Crypto can perform well in this environment, particularly if liquidity remains supportive. The second stage is the late cycle. Growth may still be strong, but inflationary pressure can increase. Central banks may become more restrictive. Valuations may become stretched. Crypto can become more volatile because investors are increasingly focused on the possibility that financial conditions will tighten. The third stage is contraction or recession. This is where risk appetite can deteriorate rapidly. Investors may reduce leverage and sell speculative assets. Crypto can experience significant drawdowns, especially if the market was heavily positioned before the downturn. And then we have recovery. As financial conditions stabilize, recession fears may fade, liquidity can begin improving, and investors can gradually rebuild exposure to risk assets. Crypto can sometimes respond very strongly during this transition because it is one of the more volatile parts of the financial system. And that brings us to another important topic: crypto's internal market structure. Not all cryptocurrencies respond equally to macroeconomic conditions. Bitcoin is generally the most liquid and institutionally followed digital asset. Ethereum has its own fundamental drivers, including network activity, decentralized applications, staking, and ecosystem developments. Smaller altcoins can be substantially more speculative. During a strong risk on phase, capital may move from Bitcoin into Ethereum and then into smaller assets as traders become increasingly confident. But during risk off periods, that process can reverse very quickly. Capital can move back toward Bitcoin, stablecoins, cash, or outside the crypto market altogether. This is why Bitcoin versus altcoin performance across market cycles can provide another useful lens for understanding risk appetite. There's also the issue of leverage. Crypto derivatives markets allow traders to take positions that are much larger than their underlying capital. That can amplify both gains and losses. When the market is rising, leverage can accelerate upward momentum. When the market turns lower, forced liquidations can accelerate the decline. This creates a feedback loop between price, positioning, and volatility. So, when analyzing crypto during macroeconomic stress, it's useful to ask not just, what is the economic data saying? Also ask, how is the market positioned? Are traders heavily leveraged? Are funding rates elevated? Are open positions increasing rapidly? Are investors aggressively chasing momentum? These questions can help explain why the market sometimes reacts far more dramatically than the macro news alone would suggest. Now, let's turn all of this into something practical. How can traders actually use macroeconomic information? The first step is to identify the current market regime. Ask yourself, are financial conditions becoming easier or tighter? Are interest rate expectations moving toward cuts or hikes? Is inflation accelerating or cooling? Are bond yields rising or falling? Is the US dollar strengthening or weakening? Are equity markets showing strong risk appetite or defensive behavior? Is volatility increasing? And what is happening with crypto leverage? You don't need to predict every variable perfectly. The objective is to develop a framework. For example, if liquidity is improving, interest rate expectations are becoming more accommodative, volatility is falling, and equity markets are strong, the overall environment may be becoming more risk-on. That doesn't mean you automatically buy Bitcoin. Instead, it means you understand that the macro backdrop may be more supportive of risk assets. Likewise, if inflation is unexpectedly strong, bond yields are rising, central banks are becoming more hawkish, the dollar is strengthening, and volatility is increasing, you may be looking at a more defensive environment. Again, that doesn't tell you exactly what Bitcoin will do. It tells you that the environment may require greater caution. This distinction between macro context and trading signals is extremely important. Macro analysis shouldn't replace risk management. It should complement it. Traders should still consider position sizing, stop-loss strategies where appropriate, diversification, leverage, liquidity, and time horizon. If you're interested in putting this type of macro-aware analysis into practice, having access to a suitable trading environment can make a meaningful difference. You can explore the Crystal Ball Markets trading platform here, crystalballmarkets.com/platform. It's designed as a modern, user-friendly trading environment for accessing and analyzing multiple financial markets, with tools intended to support traders as they evaluate price action, technical indicators, economic events, and broader market conditions. So if you're ready to take your market analysis further, explore the Crystal Ball Markets platform and discover a cutting-edge, user-friendly trading environment built for today's multi-asset trader. And if you're still developing your understanding of macroeconomics, investing, and financial markets, don't underestimate the value of consistent education. That's actually one of the reasons we created this podcast. You can also explore the Crystal Ball Markets Financial Market Insights podcast here, rss.com/podcast/crystalballmarkets. You'll find beginner-friendly discussions covering trading, investing, macroeconomics, financial markets, market regimes, volatility, portfolio concepts, and practical ideas that can help traders develop a stronger understanding of how different markets interact. So, if you're looking to build your market knowledge while keeping the explanations practical and accessible, listen to the Crystal Ball Markets podcast and continue learning about trading, investing, macro, and financial markets. Before we wrap up today's episode, let's bring everything together. The biggest lesson is that crypto doesn't exist in a vacuum. Bitcoin and the broader cryptocurrency market are increasingly connected to the global financial system. Interest rates influence financial conditions. Inflation influences monetary policy expectations. Monetary policy influences liquidity. Liquidity influences investor risk appetite. Risk appetite influences capital flows. And capital flows can have a significant impact on cryptocurrency prices. That's why crypto and AMP, macro correlation, is such an important concept for modern traders. But remember, the relationship is constantly evolving. There will be periods when Bitcoin behaves like a high beta risk asset. There will be periods when Bitcoin's unique monetary characteristics become more important. There will be periods when macro dominates. And there will be periods when crypto-specific developments take center stage. The goal isn't to find one permanent correlation. The goal is to understand the current regime. Ask yourself what is changing, why it is changing, and how markets are responding. Pay attention to risk-on versus risk-off dynamics. Watch interest rates. Monitor inflation. Follow bond yields. Keep an eye on the US dollar. Understand liquidity. Watch leverage and positioning. And most importantly, remember that no single indicator can explain every move in crypto. Successful market analysis is about putting multiple pieces of information together. So, whether you're a newcomer trying to understand how crypto behaves across economic cycles, or an experienced trader looking for a stronger macro framework, the same principle applies. Don't just watch the price. Understand the environment surrounding the price. I'm Sophia, and you've been listening to Financial Market Insights for Traders. Thanks for joining me today. Until next time, stay curious, manage your risk carefully, and keep learning.